Hello everyone. In this video, we'll understand about inventory or stock control and different terminologies being used in inventory control. A business or an industry usually maintains a reasonable inventory of goods to ensure smooth operation. Traditionally, inventory is viewed as a necessary evil, necessary because it will avoid any interruptions, evil because it actually adds the cost to the company. So too little of it causes costly interruptions. Too much of it results in idle capital. That is why we say it is a necessary evil. Hence, inventory control focuses on determining the inventory level that balances the above two extremes. An important factor in the formulation and solution of an inventory model is that the demand per unit of time of an item may be either it is known, that is deterministic, known with some certainty, or probabilistic, described by a probability distribution. An inventory policy answers the following two questions. One is how much to order, another one is when to order. The answer to these questions is rooted in minimizing the following cost model, means total inventory cost will be equal to purchasing cost plus setup cost. You call it a setup cost in case of manufacturing model, and you call the same thing as ordering cost in case of a purchase model. Holding cost, which is nothing but inventory carrying cost, and then shortage cost whenever shortages are happening and due to which we incur some cost. Now let us see individually what are these costs. Purchasing cost is based on the price per unit of the item. It may be constant or it may be offered at a discount. This is denoted by capital P and is expressed as rupees per unit. Then ordering cost represents the fixed charge incurred when an order is placed, irrespective of the order quantity. So it depends on the number of orders, the total ordering cost will go up. If the more orders, more ordering cost. This is denoted by C suffix O and is expressed as rupees per order. Then setup cost represents the cost incurred to set up a machine to produce the desired quality. Means when we manufacture, till the time we get a desired quality, we say it is a setup time which is happening, and whatever product which is being produced may not be of the desired first quality. So that much losses may be there for that particular product, whatever is being produced. So that we together consider it as a setup cost. So more number of setups actually will increase your total setup cost. This is denoted by again CO only, because this ordering cost, when it comes, it will come in purchase related model. When setup cost comes, it will comes in manufacturing related models. We use the same notation for both. And again, it is expressed as rupees per setup. Holding cost represents the cost of maintaining inventory in stock. We can say it is the cost to the company towards carrying inventory. So it includes the interest on capital and the cost of storage, maintenance, and handling. This is also called inventory carrying cost. This is denoted by capital C suffix C and is expressed as rupees per unit per annum. Shortage cost is the penalty incurred by the organization when it runs out of stock. It includes potential loss of income and the more subjective cost of loss in customers' goodwill. This is also called stock out cost. This is denoted by, actually it should be CS and is expressed as rupees per unit per year. Minimizing the above cost model is done by partially differentiating the total cost with respect to the quantity, applying the maxima minima principle of differential calculus. So when we come across with the different models, that time we will do all these derivations. How do we arrive at an economic order quantity or an economic batch quantity? So this will give us the desired economic order quantity, how much to order, and the time between two successive orders, that is when to order. Some more terminologies we'll see what are used in inventory control. One is lead time. When an order is placed, it may be of instantaneous delivery or it may require some time before delivery. The time between the placement of order and its receipt is called lead time. Again, the lead time may also follow a probability distribution. That is, the lead time is certain or uncertain. Most of the times it will be uncertain only. Reorder level. It is the stock level at which an order is placed so that we receive the items against the order at the beginning of the next cycle. Mathematically, it is calculated as ROL equal to D suffix LT, which is demand during lead time, plus SS, that is safety stock, plus RS, which is reserve stock. And D suffix LT can be calculated as demand rate per period multiplied by the lead time in periods. Here the period may be days or weeks or months, etc. SS is nothing but safety stock we already spoke about, and RS is reserve stock. Buffer stock or safety stock, what do we mean by that? Generally, demand is uncertain and cannot be predetermined completely. Lead time is not always known exactly. The revenue foregone by not keeping adequate inventory, that is cost of understocking and sometimes payment of penalty for not meeting the delivery schedule, or the consequences of inadequate inventory models. To overcome the situations of uncertainty in demand and lead time, some extra stock is advisable so that the shortages may not occur. This extra stock is known as a buffer stock or a safety stock. Mathematically, it is calculated as SS, that is safety stock, equal to Z times sigma, where sigma is the standard deviation of the demand during lead time in case of quantity system, and it is standard deviation of demand during lead time and review period in case of period system, periodic review and quantity based review. And Z is nothing but the standard normal statistic value for a given service level. Means if you want the service level to be 95% service level, means only 5 times failure you can accept. 95 times you want to service to the shop floor whenever they ask for a requirement. That time the service level will be considered as 95%. Means you can also correlate this with the confidence level, confidence limits or confidence level. Standard deviation in demand during lead time is calculated as sigma is equal to square root of lead time multiplied by standard deviation per period if a Q system is adopted, and standard deviation in demand during lead time and review period is calculated as sigma is equal to lead time plus review period times standard deviation per period if periodic system is adopted. Reserve stock, it is the average demand during delivery delays. Mathematically, it is calculated as RS equal to demand during a period multiplied by maximum delay multiplied by probability of maximum delay. Fixed order quantity system, that is what we spoke about, Q system. In this inventory system, whenever the stock level touches the reorder level, an order is released or placed for the fixed quantity which is equal to economic order quantity. Periodic review system, P system. In this inventory system, stock position is reviewed once in a fixed period, that is called as review period, and an order is placed depending on the stock position. Mathematically, the review period is calculated as economic order quantity divided by the annual demand. Then comes lot size or batch size. It is that quantity, a stage of supply chain, either produces or purchases at any given point of time. To understand lot size or batch size, let us consider the following example. A firm which sells 5 personal computers daily or per day normally would stock or order for 100 personal computers. Then we can say that the firm is holding an average stock of 20 days, which is calculated as 100 divided by 5. Cycle inventory is the average inventory builds up in the supply chain and is defined as cycle inventory is equal to lot size divided by 2. So in case if normal usage, minimum usage, maximum usage, lead time are known, then how do we calculate the following? One is reorder level of the stock. We can calculate it as maximum usage into maximum delivery period. Maximum level of stock can be calculated as ROL plus EOQ minus minimum usage into minimum delivery period. Minimum stock level can be calculated as ROL minus of normal usage into normal delivery period. In this case, whenever we say normal delivery period, it will be the average lead time. So these are some of the terminologies. In our next video, we will understand about some of the inventory models one by one and with some numerical examples also. Thanks for watching the video.